Welcome to Doc Does Financial History, where money, power, and history collide, and nothing is ever as simple as it looks.
You walk into a fancy Manhattan office. The kind of office where the carpet feels like velvet under your shoes, the walls are lined with framed degrees, and the receptionist greets everyone with a warm, practiced smile. You've come here because you've heard about Bernie Madoff. Maybe a friend recommended him, maybe you read about his investment firm in the newspaper. You want your money to grow. After all, who wouldn't want a piece of the financial genius everyone in the city seems to trust? You sit down, and Bernie Madoff himself greets you. He's calm, confident, and charming, exactly what you imagine a Wall Street legend should be. He talks about steady returns, consistent profits, and a strategy so simple that it almost feels too easy.
You'll see, he says.
Your money will work for you, quietly, reliably. And it does feel safe.
Almost too safe.
But here's the twist. There's no actual investing happening. Not really. For decades, Bernie Madoff was running the largest Ponzi scheme in history. A scam that defrauded thousands of investors out of $65 billion. And it wasn't just wealthy Wall Street clients. Charities, universities, individual retirees, people who trusted him with their life savings, all fell into the trap. It sounds unbelievable, right? How could someone operate a scam of this magnitude for so long without anyone noticing? Well, the answer lies in trust, secrecy, and a carefully built reputation that allowed Madoff to hide in plain sight. Bernie Madoff didn't start out as a criminal mastermind. He began his career on Wall Street in the 1960s, running a small investment advisory business. Over time, he became well-connected, respected, and known for delivering steady returns. In the financial world, consistency is gold. Even when the markets crashed, Madoff's clients saw small, reliable profits. This was exactly what attracted more investors, the promise of safety in a world of financial chaos. And that's the beauty and danger of a Ponzi scheme. You see, it doesn't rely on making legitimate profits. It relies on incoming money from new investors to pay returns to older investors. As long as more people keep investing, the illusion of wealth continues. But once the flow stops, the entire house of cards collapses. Madoff's brilliance was in how he maintained that illusion. He created falsified trading records, fake account statements, and a small network of insiders who helped him appear legitimate. He convinced accountants, lawyers, and even regulators that everything was above board. And when people asked questions, he deflected, reassured, or outright lied. At its peak, Madoff's operation wasn't just large, it was astronomical. He managed billions in what investors thought were legitimate portfolios, but in reality, most of that money was simply being shuffled around, used to pay earlier investors or fund his own lavish lifestyle. Homes, yachts, luxury cars. Madoff enjoyed a life most could only dream of, funded entirely by other people's savings.
But let's pause for a moment.
This wasn't just a story about one man getting rich. It was about how a system designed for transparency and regulation failed spectacularly. For decades, Madoff operated with almost no scrutiny. There were red flags, sure, suspicious patterns and irregularities, but somehow the regulators didn't catch on. Even the Securities and Exchange Commission (SEC) was repeatedly warned about Madoff's activities, yet investigations were cursory, delayed, or mismanaged. So, why didn't anyone stop him sooner?
It's complicated.
Part of it was his reputation. Part of it was the sophistication of his deception. But another part was human psychology. People want to believe in success, and when someone presents themselves as trustworthy and proven, we often suspend our skepticism. Madoff exploited this in the most extreme way imaginable. The collapse came during the 2008 financial crisis. As markets plunged, investors rushed to withdraw their money. Suddenly, Madoff didn't have enough incoming funds to pay out the redemptions. The Ponzi scheme unraveled almost overnight. What was once a carefully constructed empire of illusion became a financial catastrophe, exposing the depth of the fraud. Thousands of investors were devastated. Entire retirements were wiped out. Charitable foundations lost decades of funding. Even famous families and celebrities weren't immune. The scope of the devastation was staggering. Estimates suggest that actual losses, after recovery efforts, were around $18 billion, but the total amount reported on paper, including fictitious gains, was $65 billion. And the ripple effects didn't stop at the victims. The Madoff scandal shook global markets, undermined confidence in investment firms, and caused people to question the integrity of financial institutions. Banks that had invested with Madoff faced scrutiny. Hedge funds that funneled client money into his firm were criticized. Regulators were publicly embarrassed. The scandal became a cautionary tale about greed, trust, and the vulnerabilities in even the most sophisticated financial systems. Bernie Madoff himself was arrested on December 11, 2008. He eventually pled guilty to 11 federal felonies, including securities fraud, wire fraud, and money laundering. In 2009, he was sentenced to 150 years in prison, a symbolic sentence reflecting the enormous damage he caused. Madoff spent the rest of his life behind bars, dying in 2021 at the age of 82. But beyond the headlines, there's something deeper here. Madoff's fraud wasn't just about a man lying to make money. It was a mirror to human behavior. It showed how much we crave certainty, how much we trust appearances, and how vulnerable even intelligent people can be to deception when they let greed cloud judgment. It also raised questions about oversight and accountability. How could such a massive operation go undetected for so long? How could regulators repeatedly miss the obvious signs? The answers are both technical and human. Systems of control can fail, and people can be blinded by desire and trust. Even today, Madoff's story serves as a reminder: if something seems too good to be true, it probably is. High, consistent returns with little to no risk. This is the hallmark of a Ponzi scheme. And yet, time and again, people fall for it. We like to believe in safe havens, magic formulas, and the promise of easy wealth. Madoff exploited that in a way that had consequences we're still trying to understand fully. Recovery efforts have been ongoing since his arrest. A court-appointed trustee, Irving Picard, worked tirelessly to recover assets for victims. Through lawsuits, settlements, and asset seizures, billions have been returned, but it's a fraction of what was lost. Many victims, especially individuals who invested life savings, will never fully recover. Families were destroyed, businesses collapsed, and countless dreams vanished. And here's another layer: Madoff's fraud didn't just take money, it took trust. People began questioning every investment, every financial advisor, every market claim. In the aftermath, the ripple effects created a climate of skepticism that influenced investor behavior for years, reshaping how hedge funds, banks, and individual investors approached risk. It also exposed a cultural aspect of finance: the glorification of success without accountability. Madoff was seen as brilliant, charismatic, and untouchable until the scheme collapsed. The lesson is clear: charisma and reputation can hide systemic flaws. It reminds us that due diligence, skepticism, and regulation are not optional, they are essential. And while Madoff is gone, the lessons remain urgent. Financial fraud hasn't disappeared. In fact, as technology evolves, new forms of Ponzi schemes and scams emerge. Cryptocurrency, online investments, and complex derivatives are the modern playgrounds for deception. Bernie Madoff's story is not just history, it's a warning. It asks, what systems are we missing today that allow billions to vanish quietly? Who is profiting, and who is losing? The scale of his fraud, $65 billion, is hard to grasp. To put it in perspective, that's roughly the GDP of some small countries. It's more money than most individuals will ever see in a lifetime. And yet, it was all built on a simple human weakness: the desire to trust, the hope to grow wealth, and the reluctance to ask uncomfortable questions. So, as you walk away from the story of Bernie Madoff, consider this: the man was just one part of a larger system. A system where human psychology, greed, trust, and insufficient oversight intersected to create one of the biggest financial disasters in modern history. And while Madoff is gone, the system he exploited still exists. It's up to regulators, investors, and society to remain vigilant. The lesson is timeless: always question, always verify, and never let charm and consistency override skepticism. Madoff's fraud wasn't just about numbers, it was about human nature. And human nature hasn't changed. Thank you for watching this episode of The Big Picture. If you want to learn more about financial fraud, the psychology behind scams, and how global markets are shaped by trust and deception, check out our other episodes. Share your thoughts in the comments below, like and share if you found this story compelling, and consider subscribing to stay informed. Until next time, stay alert, and remember, in finance as in life, if it seems too good to be true, it probably is.